Well, healthcare was the focus this past week on Capitol Hill. It's probably going to be the focus next week as well. In the mind of investors, tax reform is still the main event, though. And with all three major indices hitting all-time highs recently, it is clear that there is still optimism that tax reform will happen on Wall Street. When I was in Washington earlier this week, I had the chance to speak with London Stock Exchange CEO Xavier Rolet about tax reform and a lot more.
I have the highest respect for some of the very senior officials that are driving economic policy in the Trump administration, Mr. Gary Cohn, Mr. Steve Mnuchin, fellow Goldman Sachs alumni, of course, of note and far greater fame. And they have articulated a strong plan to make the U.S. economy more competitive. And so tax policy is an important part of that. And I think some of the issues that have been raised, repatriation of overseas capital, putting more of that, if you want, idle capital resulting from many, many years of profit accumulation, putting that back to work in the real economy, investing in plant and equipment, investing in infrastructure. There's a real subject in the United States, a country that I love. My family are Americans, or at least half of them. But it is no doubt that in the last few decades, American infrastructure has received less attention than it should have. So the focus on these issues of productivity, of investment in the real economy, of making the economy more competitive, protecting an economy is only an admission of weakness. And in the end, protectionism, as we all know, results in a greater poverty spread amongst a greater part of the population than wealth creation. But focusing on making the U.S. economy more competitive, and we have the same debate right now, we talked about it earlier, as regards the EU, which has been an uncompetitive segment of the world economy for a long time, with, of course, a mixed picture. Germany or the UK ahead, and the southern countries really lagging. So I think that focus is essential. Now, of course, there is a legislative agenda with some sequent sensitivities between reform of the healthcare plan or the Obamacare and tax reform. And all of these must be looked in detail, and it's really not appropriate for me from overseas to comment on the appropriateness of, for example, healthcare reform. But what I can tell you is from a distance, representing what we hear from global investors, but also as an operator of significant businesses in North America. We have about, I know this may be modest compared to manufacturing companies, but we have close to 700 employees spread in 6 offices in the United States. So we have a good feel for the economy. There is, in general, a better sense of optimism as to what the potential impact of a productive tax reform and the impact that this could have on investment. Whilst the U.S. economy traditionally has been led to the tune of about 75% by consumer spending, it is probably time for investment to take up some of the slack, lest we are willing to let citizens continue to borrow and grow their personal indebtedness, which I think everyone would agree is not the right solution. So the gist of that tax reform seems to, certainly to us, to be potentially very favorable to the economy. There's no doubt, and this ties into the first question you asked me, is that the continued presence of, I would say, accommodative monetary conditions, not just in the United States, but also in Europe, the UK, and elsewhere in Asia, is taking volatility out of the real economy, is also distorting, to a certain extent, the curve in terms of return for investment, and is leading to risk at time potentially being mispriced. So from our standpoint, if we could see gradual tax reform with a gradual readjustment of monetary conditions, together with continued investment in infrastructure and technological innovation, it seems to us, we're seeing this happening now in the US and potentially in the EU, which is undergoing a recovery, in China, which I highlighted earlier, is growing quite strongly, and India. It seems to me that the world economy is not in such bad shape after all. It's just about avoiding major policy mistake and encouraging business to invest more.
London is a major international hub in terms of the financial markets, and I'm wondering if that gets impacted as Britain leaves the EU. Now, we know that President Trump and Prime Minister May have discussed a potential trade deal. The president in the U.S. has said the U.K. is at the front of the queue, that the U.S. wants to do a deal, a good, strong trade deal with the U.K. Do you expect that to include services and jobs, whereas the major Wall Street firms can keep their presence in London?
Well, I think that's an excellent question, Maria. And if you look at the UK, EU, or the US GDP, circa 75% of that GDP is led by services. So whilst there's a lot of debate about manufacturing and the export or import of manufactured goods, the real question, the meaningful and impactful question, of course, is about services. And here I think the UK, particularly the financial services industry in the United Kingdom, has a major advantage, is that it is truly global. If you look even at the businesses of the London Stock Exchange, in indices, in clearing, they're not US or EU or UK focused, they are global businesses. It's fair to say that certain jobs that are specifically connected to EU-based activities will migrate, and some of them have already migrated or announcements have been made. But I think jobs that are connected to global services or the servicing of global needs as articulated by EU corporate issuers, banks, or investment management companies and other stakeholders, those will definitely stay in the UK and in London, and really this is really the bulk of what these jobs are about.